Housing inventory is spiking across the entire country. And with tariff threats creating a dramatically uncertain landscape, well, buyers, they're moving to the sidelines. It's setting 2025 up to be a year where we may very well experience multi-year high levels of inventory. And in some areas, records are already being broken. So in this episode, Ryan and I are going to break down where the significant spikes are taking place and update you on the economic forces that are shaping the housing market in 2025, including the most recent mortgage arrears data. And we're going to poke some holes in last week's job report, as it may have missed the mark by a sizable amount. Now, just this week, we were notified that our team, the Vancouver Life Real Estate Group, achieved President's Club status in 2024. That means we reached the top 1% of sales in Greater Vancouver, selling more real estate than 99% of the realtors across the Lower Mainland. And we just wanted to share our sincere appreciation for this and ultimately say how thankful we are to all the clients who worked with us over this last year and helped us achieve this significant milestone. So thank you. It truly means the world to us, and we promise to continue to deliver top tier service. Now, what's more is, for those of you who have been watching this channel for some time, you know that we've been sort of at the forefront of talking about the multiplex plan, or otherwise known as Bill 44, since before even that it was enacted. And we've been educating viewers through interviewing people like developers and architects and builders about this sweeping legislation and how its intent is to, of course, bring more housing to BC and especially here in Vancouver. Well, today we are very excited to share with you first that we have just launched a multiplex project, one of the first of its kind in Vancouver. It's 6 luxury units located on Vancouver's west side, and these are big. They're 4-bedroom units ranging from about 1,980 square feet up to 2,057 square feet. They feature over 10-foot high ceilings and have these incredible high-end German engineered kitchens. If you would like to learn more and see what these multiplex units look like, just check out our website. We've just gone live. It's aderawest.com. That's ADERA West.com. Now, let's dive into supply. Supply. There is lots of it to start the year, and we're going to dissect exactly what's happening. So most of the national housing data is out for January, and by far, the most notable change is the massive jump in new listings seen across Canada. We reported on Vancouver's inventory spike just last week, and that appears to not be a localized phenomenon. It's happening across all of our country. On the lower end of jumps, we saw Montreal with a 10% increase month over month, Calgary 18% month over month, but then here come the much bigger numbers. British Columbia as a whole was up 27% year over year. Vancouver, as we mentioned, 33% year over year. That was a 13-year high for that metric. And in Toronto, well, they take the cake. They're up 49% in active inventory year over year, hitting a 16-year high there. Now, when it comes to breaking records, new listings for condos, they hit an all-time high in both Toronto and Vancouver. And that's a segment of the marketplace that is already experiencing downward pressure. So ultimately, we want to know what's causing the spike in these numbers. What's creating all these record-breaking inventory levels? Well, first, there was about 210,000 completions that took place last year, and predominantly those were in the condo space. Many of those are coming to market and being listed to sale. Second, in places like BC, we've got our Airbnb ban coupled with tenancy laws that lean a lot in favor of tenants. And you know what? Some investors are just offloading because of these. And third, obviously, the higher mortgage payments coupled with lowering rent prices, well, that's pushing some investors too far into negative cash flow territory, and they're just offloading those units as well. So higher supply looks to be the story of at least early 2025. And now we will watch and see how long that remains.
Yeah, and Dan, I would say, just from a boots on the ground perspective too, it's the case with our buyers. They just, or buyers generally speaking, both in terms of what we have listed and who we're out with, that urgency from buyers is just not there. And I think, there was that push from a lot of last year for people who didn't sell. They've come to the market right away here. So we are definitely seeing those elevated levels of supply, and it's having an effect on the drive that buyers would have in this market, typically in the start of a spring market. Speaking of buyer side demand, I guess the question remains, is it going to build? And looking at the long-term sales trends, it's clear that the past 2 years has been well below average for BC and Ontario. Historically, this leads to sales in the following years, and combine the demand with lowering rates, lowering prices, and now more options, i.e., higher levels of supply, there could be an increase in buyers too, though, as predicted earlier, only enough to really bring sales volumes into their long-term averages. Let's take a look here at the early data from Toronto, for example. Sales jumped 10% month over month in January, but that's still down 8% from 2024 levels. In Toronto, buyers have a lot to choose from. Inventory is up a whopping 70% year over year. Interestingly, though, that is not just in condos, which is what you've typically been seeing in the headlines. The amount of detached homes available, too, is almost double what it was this time versus last year. So the sales to new listings ratio, a predictor for future pricing trends, hit the lowest levels since the global financial crisis. Prices look out below in Toronto. The seasonally adjusted average price dropped 2.1% just last month and is down 6 of the past 7 months.
So one thing that might be driving prices down and the ability to maybe not pay mortgages in the upcoming months is, of course, consumer insolvencies, people who are just stretched to their absolute limit. And this is something that's been trending upwards since around 2 years ago when those high interest rates really started to take effect. Understandably, Canada's household debt levels, well, it continues to rank among the highest in the world. And many people are ultimately reaching their financial breaking point. We just got new data from the Office of the Superintendent of Bankruptcy, and it revealed that in December of 2024, it was one of their busiest months in years for consumer insolvencies, with filings surging to a rate that we haven't seen again since the global financial crisis. So many references to that era. There were 9,300 filings in December, and that's about a 3% increase year over year, but it marked the highest number of December filings in 5 years, capping off a year of basically record-breaking insolvency trends. In total, 137,000 consumer insolvency filings were recorded in 2024. Now that is an over 11% increase from 2023, and it makes it the second highest year on record for filings, surpassed only by, you guessed it, the 2009 recession caused by the global financial crisis. So despite recent stronger than expected economic data, consumer insolvencies paints a very different picture. With insolvency growth tracking at levels comparable to the GFC, that financial strain on Canadian households is becoming increasingly difficult to ignore. Rates did not come down fast enough for these people who had to and are still likely making some pretty challenging decisions.
Yeah, so let's touch here on U.S. inflation. As U.S. inflation did pick up last month, driven by rising costs for groceries, gasoline, and shelter, specifically rent, a setback for households and businesses that are already grappling with these higher expenses. The increase reinforces the likelihood that the Federal Reserve will delay any further interest rate cuts in the near term. Powell's comments suggested that anyhow. But according to the Labor Department's latest report, the CPI rose 3% year over year in January, up from 2.9% in December. This marks a continued climb from its 3.5-year low of 2.4% in September. The data highlights that inflation has remained persistently above the Fed's 2% target for the last 6 months. Meanwhile, Donald Trump has pledged to lower costs, though economists warn that his proposed tariffs could temporarily push prices even higher, or perhaps more than temporary as well. Usually when it comes to tariffs, once a tariff is placed, the prices, even if the tariffs go away, remain. This unexpected rise in inflation has significant implications for the real estate market. Elevated inflation often leads to higher mortgage rates as lenders adjust to maintain their margin profit or their profits and their margins. It can also lead to higher home prices as building materials cost will rise, and that gets passed on to the consumer. And to be clear, This isn't the kind of price appreciation that we would like to see, as it's the result of monetary policy or geopolitics as a result instead of productive value, or the result of higher incomes, which could increase purchasing power, which would relate to demand. This feels magnified here in Canada as well. And it has the makings, in my opinion, of what could be the start of stagflation, which is the persistent higher than anticipated inflation combined with elevated levels of unemployment and stagnant demand throughout the country's economy. Consequently, potential home buyers may face increased borrowing costs, potentially dampening the demand in the housing market.
So, as this episode is largely about supply and the economics that drive supply, let's talk about future supply. Because as of today, obviously, supply is spiking, and it's maybe contrarian to discuss a housing shortage. So that's exactly what I'm going to do. Because we know the pendulum swings, both ways, and recently more extreme. And I want to shed light on what we might expect come late 2026, 27, and beyond. Because new homes under construction, especially across a place like the GTA, well, they dropped almost 3% in December. And that's already down 12% from the peak. And this is just the beginning. For example, there were only 51 new units started last month in Toronto. Units, not buildings. Okay, 51 units. And that is the lowest of any month ever recorded dating back to the mid-90s, a 30-year low. And we can expect these similar type of low numbers in the upcoming months as well. Overall, condo starts in Toronto are already at a 4-year low and dropping fast. Back here in Vancouver, new homes under construction fell 3% in December, the largest decline seen in 3 years. And condo units fell 5% just month over month. So while it seems like there's plenty of supply to go around today, date stamp this episode and let's revisit it in 2 and 3 years and see where inventory is at. What's more is detached homes are almost disappearing entirely, with construction levels at a 16-year low. But looking even farther forward, building permits for detached homes, they're at a 45-year low. No one really is building single-family homes anymore, and understandably so. But also on the other side of that, if you happen to own a single-family home, maybe hold on, because the sheer scarcity of that type of home, of that asset class, will likely boost up prices long-term.
Yeah, I personally don't think you're going to see a whole lot of single-family homes being built. I don't know if that stat's ever going to get much better. Just within the major metros, the density moving forward, the plans moving forward, they just don't include single-family homes. So like Dan said, if you've got one long-term, the scarcity element of it and what it would provide, as well as its future development potential, it's big. It's big. Now, Dan mentioned earlier in the episode here that there were some inconsistencies with the jobs report that we saw last week. And I want to touch on some of this unemployment because I think there's some discrepancies that need to be made. Last week, we shared the unemployment numbers, which showed a decrease from 6.7 to 6.6%. The thing is, the more you dig, the harder the downward trend is to believe. For reference, Canada relies on 2 primary employment surveys: the Survey of Employment Payrolls and Hours, also known as SEPH, and the Labor Force Survey, or LFS for reference. These 2 measures typically align, but occasionally there's some discrepancy between the 2 of them. Historically, when differences arise, the payroll survey, the SEPH survey, has proven to be the more reliable indicator. This makes sense, as that indicator is based on actual payroll remittances, whereas the labor force survey is data gathered through phone surveys. So this distinction is particularly relevant now, as the 2 surveys are currently presenting 2 very different narratives, and they both can't be true. So let's begin with the payroll data from late last month, which indicated that Canadian businesses lost 56,000 jobs in November, a stark contrast to the labor force survey, which reported 42,000 job increases for the same period. This marks the 3rd consecutive month of employment losses. As a result, private sector payrolls have shown a steep year-over-year decline. Then just last week, the more widely followed and real-time LFS report for January painted an entirely different picture. It showed a massive 76,000 job increase, 3 times higher than the consensus expectation that was at 25,000, following an even larger 91,000 job gain in December. These staggering employment figures completely contradict the downward trend seen in payroll data, and both cannot be taking place simultaneously. So let's consider the next few points. The ranks of the unemployed were up 20% year over year, but what's striking is the steep uptick in long-term unemployment. Long-term unemployment, which is 52 weeks or longer, has more than doubled in the past year, a pace of increase that we only see when we are in a recession. Permanent layoffs hit their highest level since March 2021. And does it really make sense that job creation was strong enough to offset this, especially with all of this talk of tariffs that typically scare companies? And they don't look to hiring practices during a time like this. It's unlikely. Dissatisfied quitters dropped 21% year over year, hitting their lowest level since the pandemic lockdowns in 2021. And before that, you'd have to go back to 2012 to see numbers this low. And when the job market is strong, people feel confident quitting, naturally, because they can go to somewhere else. This decline suggests that the opposite is taking place. Wage growth slowed to 3.5% in January, down from 4% in December, marking the weakest pace since April of 2022. On a 6-month rolling basis, it's even softer than just 1.3%, the lowest since late 2021. Unemployment in Toronto and Vancouver is at its highest level outside of the pandemic in over a decade. However, if population estimates are inflated, the actual jobless rate could be slightly overstated too. It works both ways. Ultimately, our view is that the unemployment rate is being underreported and could see a sizable jump in the next couple of quarters.
Some great points there, and really illustrates, I don't know, either how hard employment is to track here or that they're using incorrect metrics, perhaps. I mean, it's almost like our population counter, right? When the government literally does not measure how many people permanently leave, how do you know how many people are left? So, I mean, sure, it washes out over time, but really hard to get a almost real-time snapshot of reality in that sense. But let's move on here because I want to talk about the arrears rate because the newest mortgage arrears data is in, and it brings us up now to the month of November, right? The data takes a while to process, and right now we're up to November of 2024. The month over month mortgage arrears rate remained unchanged and is sitting now at 0.21%. 4 months ago, 4 months prior, it was only at 0.2%. So over the past 4 months or 4 months of data here, it's only increased by 0.01%. British Columbia and Quebec, they remain the lowest nationally at 0.17%. Now, Ontario was there as well last month, but they've actually increased a little bit now, Ontario, at 0.18% in November. And I'll always remind people, pre-pandemic, the arrears rate nationally was 0.25%, and we're at 0.21 today, okay? But also note that like pre-pandemic, the overnight rate was 1.75%. Today we're at 3%, right? So there is technically lots of room for that arrears rate to continue to climb. But let's have a look at history and see what happens to home prices in Canada when the arrears rate rises dramatically, right? There's a lot of people, I think, focusing on arrears, thinking this is the thing that's going to send the market crashing. So let's, look at history for some references here. The data for Canadian arrears, mortgage arrears, that is, goes back to 1995. So we'll work within that 30-year range that we have data for. From 95 to 97, the arrears rate was at the highest on record, reaching 0.65%. And just remember, the USA is more than double that today. So what happened with Canadian home prices during those 2 years when the arrears rate was at an all-time high? They actually rose. Prices rose during an all-time high arrears rate. Now, let's be honest here, that increase was quite marginal, and we'll post some charts here so you can see exactly what happened then. But the point is, what prices didn't do with record high arrears rate was they didn't drop. And I personally was not expecting that. Okay. When I dug up this information, I was expecting prices to drop with high arrears. Now, sure, I know today is wildly different than 1995 and history may not repeat, but it also suggests that if you're of the belief that a spike in arrears rate will equal a price crash, well, there's simply no data that supports that thesis, at least not in Canada. Okay. Obviously, one metric, one data point doesn't control housing as a whole, right? We are a country where homeowners have proven that paying their mortgage is a priority for at least the last 30 years anyway. So moving along, next from 1997 to 2008, the arrears rate lowered consistently all the way down to 0.24%. During that time, Canadian home prices rose by 45%. And for reference, the rate of inflation over that same time frame was about 24.5%. So home prices were increasing at almost double the rate of inflation. Then the global financial crisis hit and the arrears rate spiked again, 0.24 up to 0.45. And it stayed in the 0.40s-ish until around late 2011, like a 3-year snapshot in time. Let's look at what happened to prices during that. At the onset of the GFC, prices dropped rather dramatically. They fell from $320,000 to $275,000 over the span of about 9 months. That's a 16% drop that we saw nationally. What's interesting is how much the global financial crisis affected American home prices, though. Let's take a quick look there. Prices hit the cycle bottom in America by about early 2012, marking a nationwide decline of approximately 27% from the peak. So they were affected much, much harder. Home prices in the States took almost a full decade to return to their pre-global financial crisis prices. That's 10 years to recover, okay? And what is truly remarkable, though, is how quickly Canadian home prices rebounded. From the top of the market to the downturn and back, pre-global financial crisis prices returned in only 18 months. 18 months compared to 10 years. That's 7 times faster recovery than in the States. Post global financial crisis, the arrears rate steadily dropped until COVID. And then it really lowered, hitting the lowest on record at 0.14% in the middle of 2022. That coincides very closely with peak pricing. It then climbed to where we are today at 0.21%, and prices have fallen about 5% from the peak. Okay, we are down nationally around 5%. So it's clear that the arrears rate alone does not control real estate prices. We've seen prices both rise while arrears rate were low and while arrears rates were high, right? And increasing. Arrears rates go down, prices were going up, arrears rate goes up, prices go up. It is quite fascinating to uncover this. But there is one metric that has a direct effect on the arrears rate, and that is the unemployment rate. So this is what we're kind of realizing here. The two metrics, unemployment and arrears, they've run basically in lockstep for the last 30 years. And of course, for those watching on YouTube, have a look at this chart. It demonstrates that quite well. Look at how close they are tied together. Plus, when you take a look at the all-time high arrears rate, it matches with the all-time high unemployment rate, at least after the last 30 years of data that we have. For reference here, a 10% unemployment rate equaled that 0.65 arrears. Today, 6.5% unemployment and arrears are at 0.21. So historically, with a similar unemployment rate at 6.5%, we should be around more like a 0.25% arrears. So, I firmly believe the arrears rate is going to increase, at least to maybe that 0.25% for pre-pandemic levels, if unemployment rate stays kind of steady or even increases a bit. Reminder that unemployment has lowered in the last 2 months, but as Ryan just destroyed it, we don't know how real that number is. But either way, we're going to expect arrears to continue to go up. So long-winded way of saying, and to wrap up my research here, arrears rate is not the best metric to focus on when it comes to what prices may do. It absolutely reflects unemployment levels and financial stresses across the country, which leads into other areas lowering, probably like GDP and whatnot. But hopefully that all made sense. And again, just kind of shows that all the focus that even ourselves put on arrears rate, maybe it doesn't carry as much weight as we thought when it comes to prices. Ryan, want to give you the last word here. What are your thoughts on that?
It's interesting. It's very interesting data. I think one of the things that comes to my mind is, I would be very interested to see how the overall money supply tracks with this data as well, because my feeling is, as you watch arrears go up, there's people that are going to replace those people. right, in terms of taking on their home or selling that home and picking up that home kind of thing. At the same time, prices rise when that takes place, and I bet there's a correlation with the amount of money that is being printed by the government at that time as well. I almost guarantee that the money supply has something to do with overall prices and moving in between the arrears rate and unemployment. It's very interesting data, though. It's something to correlate later on.
Perfect. Well, we're wrapping up there. Reminder, check it out, aderawest.com. That is one of the first multiplex projects in Vancouver to come to market. We're super excited to share this with everyone. Have a wonderful weekend, and we'll see you here next week. Bye.